What if I told you there's a defense stock sitting on $1.48 billion in cash, zero long-term debt, and a revenue growth rate of over 1,000%, yet the short sellers are piling in harder than almost any other stock on the market right now? And what if the single most important date for this company, a date that could either confirm everything bulls are betting on or blow the entire thesis to pieces, is just days away? Welcome back to Smart Stock Sam. Today we are going deep on one of the most controversial, most explosive, and most misunderstood setups in the entire defense sector right now. We are talking about ONDAS Holdings, ticker symbol ONDS. If you are not watching this stock, you are missing a battlefield, and I mean that literally. This is a company building the software brain of autonomous warfare. It just reported record-shattering numbers. It's got Palantir in its corner, and yet the stock got absolutely demolished this past week. Why? That's exactly what we are going to unpack today. We'll break down the real financials, including a hidden accounting trick that will completely change how you read their bottom line. We'll walk through their aggressive acquisition strategy, the fortress balance sheet, and the exact technical levels you need to watch before May 28th. And if you stay all the way to the end, I'll lay out the precise trade setup that traders are watching heading into the shareholder meeting. So, if you haven't already, hit that like button. It tells the algorithm this content is worth watching, and it genuinely helps this channel grow. Let's get into it. To understand why this stock is a battleground right now, you have to start with the three pillars that define what ONDAS is doing at this exact moment in time. Pillar 1 is that jaw-dropping revenue explosion. We are not talking about modest growth, we are talking about a regime change. Pillar 2 is an aggressive mergers and acquisitions strategy that is reshaping the company from the inside out, highlighted by a $199 million acquisition of an Israeli artificial intelligence firm and a high-profile partnership with Palantir. And Pillar 3, and this is where it gets really interesting for traders, is the technical setup we are sitting inside right now. Between now and May 22nd, and then again building toward May 28th, we have a combination of 34% short interest and extreme institutional momentum that creates what I can only describe as a powder keg waiting for a spark. But before we get into that tactical picture, we have to talk about the price action from this past week because it perfectly illustrates the tension at the heart of this story. Look at what happened starting May 14th. The stock absolutely ripped, up 26.52% in a single session, closing at $11.21. The earnings report dropped, and it was a beat-and-raise situation. Investors were ecstatic, retail was piling in, and everything looked like a breakout. And then the supply hit. On May 15th, a filing for the resale of 3.34 million shares hit the wires. Just like that, the mood changed. The stock pulled back roughly 5%, as the market began digesting what that dilution actually means. By May 18th, it dropped another 8.6%, closing at $9.70. Now here is the question I want you to sit with. If the fundamentals are this strong, why are the sellers winning? Is it possible the smart money is actually using this dip to load up before May 28th? We'll come back to that. But first, let's look at the numbers that caused that initial explosion, because the growth story here is genuinely extraordinary. Total first quarter revenue came in at $50.12 million. Now, I need you to really absorb that number, because in the same quarter, just 1 year ago, this company did $4.25 million in revenue. That is not a typo. That is a 1,079% year-over-year increase. And before you say one-time fluke, consider this. Revenue grew 66% sequentially from just the prior quarter, meaning the growth isn't slowing, it's accelerating. Gross margins expanded to 49%, up sharply from 35%. And here is the number that really turned heads on Wall Street. Their product companies reached adjusted EBITDA profitability this quarter. Not next quarter, not next year, this quarter. And they did it a full 6 months ahead of schedule. In a world where high-growth technology companies burn cash for years before ever seeing a dollar of real profit, ONDAS just proved they can scale toward profitability faster than even the optimists expected. Could this be the beginning of a full operational turnaround that the short sellers never saw coming? Stay with me, because the next section is where things get complicated. If you just glance at the official earnings report and see the GAAP net income line, you might think this company is printing money. The reported figure is a mind-blowing $361.2 million in profit. You might think, okay, this company is done. They've arrived, they're minting profits. Stop right there. That number is almost entirely a paper gain. The company recorded a $389.5 million non-cash gain purely from the revaluation of warrant liabilities. That is an accounting entry. It does not represent cash in the bank, it does not represent products sold, and it does not represent actual operational success. When you strip that out and look at the core operating reality, the company is running a $42.7 million deficit. They are front-loading these expenses to support rapid production scaling, which is a legitimate and even rational strategy. But it is critical that you understand what you're actually looking at when you read that headline profit number. The short sellers know this. This gap between the paper profit and the operational loss is exactly what the bears are betting on. But does that operating loss actually matter when the balance sheet looks like this? Let's talk about the fortress. ONDAS is sitting on $1.48 billion in cash and short-term investments. And here's what makes that even more remarkable. They have virtually zero long-term debt. Their current ratio is 4.8 times. Even with a quarterly burn rate of $51 million, they have enough runway to operate for years without touching the capital markets. That is a level of financial security that you almost never see in a company at this stage of growth. And more strategically, management has identified that this cash position gives them a projected $4.2 billion in mergers and acquisitions capacity. They are not just surviving, they are actively hunting for more acquisitions. Could ONDAS be building a defense technology empire right under the market's nose? Because that is exactly what their M&A playbook looks like when you zoom out. Here is the strategic picture ONDAS is painting. They are not trying to be just a drone company. They are building a vertical stack for the future of autonomous warfare. The foundation is core hardware. They're autonomous defense drones. But hardware is a commodity. The real value creation happens at the next layer, which is AI orchestration. By acquiring Omnisys for $199 million, they added a platform with 25 years of proven battlefield coordination software. That is not some startup with a cool demo. That is deep, battle-tested, enterprise-grade technology. Then they add the intelligence layer through their Palantir partnership and the Skyweaver platform, which integrates Palantir's artificial intelligence directly into the drone fleet to create what they call layered ISR, intelligence, surveillance, and reconnaissance capabilities that tie the whole system together. They have completed or agreed to 6 major acquisitions in 2026 alone. 6 in 1 year. Whether you think that pace is brilliant or reckless, you cannot deny the ambition. But ambition without customers is just a pitch deck, so let's talk about the order book. The pre-revenue days are officially over. ONDAS now has a pro forma backlog of $457 million. That is high-visibility revenue, money that is already committed, already on the books, just waiting to be processed and recognized. This backlog is so strong that management raised their full-year 2026 revenue target to $390 million. When a company raises guidance this early in the year, it is signaling deep confidence in execution. This is why the market is currently paying a 35.4 times price-to-earnings premium. Investors are not buying today's earnings. They are buying that $457 million pipeline. But while the institutions are building positions, some insiders are heading in the opposite direction, and that contrast is impossible to ignore. Here is the tug-of-war that defines this stock right now. On one side, massive institutional accumulation. Institutional ownership is estimated between 43 and 65% of the float, with giants like BlackRock holding over 9 million shares and JP Morgan building a significant stake. The smart money is clearly long. But on the other side, the insiders are selling. We have seen 21 insider sales and 0 insider purchases in the last 6 months. 0. CEO Eric Brock recently sold 475,000 shares for approximately $4.6 million. Founders and executives sell for personal reasons all the time: liquidity, diversification, tax planning, and that is completely normal. But seeing absolutely no insider buying during a record-breaking quarter when the stock is trading at a potential discount, that is a signal you simply cannot brush aside. Is it possible management is being cautious while institutions are being bold? Or is there something insiders know that the market hasn't priced in yet? Let's talk about the risks, because they are real. First, equity dilution. That May 15th resale filing of 3.34 million shares is a direct result of the Worldview merger, and there are more potential share increases tied to the Omnis deal still on the horizon. Second, profitability timing. They are burning $42.7 million a quarter. If the backlog doesn't convert to cash at the pace management is projecting, that fortress balance sheet will start to show cracks faster than the bulls expect. And third, mergers and acquisitions friction. Integrating 6 companies in a single year is an operational nightmare under the best circumstances. There are mounting questions about the capital sources for the M-Press deal, and there is some scrutiny around former defense executives joining the leadership team. Any one of these risks, if it materializes badly, could send this stock significantly lower. The setup is extraordinary, but the execution requirements are just as extreme. So how do we weight the massive wins against these very real red flags? Here is the honest scorecard. The good: 1,000% revenue growth, nearly $500 million in committed backlog, and $1.48 billion sitting in the bank. That is a dream setup for any growth investor. The bad, persistent operating losses, an ongoing threat of share dilution, and a CEO who just sold $4.6 million worth of stock during what should be his company's proudest moment. We are sitting inside a high-risk, high-reward tactical environment. To justify the premium valuation, ONDAS needs flawless execution of that $457 million backlog. If they stumble, the fall will be hard and fast. But if they deliver, and I mean truly deliver, heading into May 28th, the short sellers are sitting on one of the most dangerous positions in the market right now. Let's talk about that short position for a second, because the technical setup here is genuinely explosive. Short interest has ballooned to 164 million shares. That represents 33 to 34% of the entire free float. Think about what that means. 1 out of every 3 shares available to trade is being borrowed and sold short by someone betting this stock goes down. This is a tinderbox. 1 catalyst, 1 positive surprise, 1 major contract announcement, and you could see a short squeeze of epic proportions. The relative strength index is currently at 44.2, meaning the stock has cooled from its overbought levels and is now sitting in a neutral zone, not overextended in either direction. Meanwhile, the options market is sending a clear signal. 71.9% of the current options flow is concentrated in call options, with heavy positioning in the January 2027 $15 and $20 strike prices. The big players are not betting on a small bounce. They are positioning for a massive move over the next year. Could this be the calm before the storm? And speaking of targets, analysts are seeing a very wide gap between where this stock is trading and where they believe it belongs. Right now, the stock is around $9.70. The analyst consensus target range sits between $17.25 and $20.12. That is an implied upside of over 100% from current levels. Even the most conservative analyst price targets represent a gap that suggests the market is pricing in risk that the professionals believe is significantly overblown. When you see a gap that wide, it usually means one of 2 things. Either the analysts are wrong or the market is wrong. Which side of that trade do you want to be on heading into May 28th? Here is your actionable setup for the window between May 19th and May 22nd. The optimal entry zone is between $9.45 and $9.60, which aligns with the $9.58.5 Fibonacci pivot level. Your support floors are firm at $9 even. the key psychological level, and $8.50, which marks the 200-day moving average. These are the lines in the sand. If they hold, the short-term target is a move back into the $10.60 to $11.20 range. Resistance ceilings sit at $10.50 and $11.60. If ONDS can break clean through the $12 psychological ceiling before or during the May 28th shareholder meeting, the short squeeze scenario becomes very real, and you would be looking at a potential gap filled toward those analyst targets in the $17 to $20 range. The setup is defined. The risk levels are clear. Now it's about execution and catalyst timing. Before I wrap this up, I need to include an important financial disclaimer. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Investing in individual stocks, particularly small and mid-cap companies in volatile sectors, involves significant risk, including the potential loss of your entire investment. Always conduct your own due diligence. Consult with a qualified financial advisor before making any investment decisions, and never invest money you cannot afford to lose. Past performance is not indicative of future results. So here's where we land. The fundamental growth of ONDAS is undeniable, but it is currently being masked by mergers and acquisitions digestion and intense short pressure. The $9 support floor is the line in the sand. If that level holds through this week and into the May 28th annual shareholder meeting, the combination of 34% short float and growing institutional conviction provides exactly the fuel needed for a rapid retest of the $12 level and potentially far beyond. Management's ability to communicate their systems of systems vision clearly and confidently at that shareholder meeting could be the single catalyst that breaks this stock out of the current consolidation or breaks it down. Watch carefully. Now here is my question for you, and I genuinely want your perspective in the comments. What do you think of squeeze? Are the shorts really trapped, or they will get away this time? Drop your answer down below, because the debate in the comments on this one is going to be fascinating. If you found this breakdown valuable, please hit the like button. It takes 1 second and it helps this content reach more investors who need it. Subscribe to Smart Stock Sam if you haven't already, so you never miss a deep dive like this one. And if this channel has ever helped you spot an opportunity or avoid a costly mistake, consider supporting us through YouTube's Super Thanks feature. Every contribution directly fuels more research, more analysis, and more content exactly like this. I will see you in the next one. Stay sharp, manage your risk, and as always, invest smart.